Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is my very good friend, Jeffrey Tucker, the founder and president of the Brownstone Institute and the author of The Market Loves You, Why You Should Love It Back. Welcome back, sir.
Hey, it's good to be here. Thanks.
Yeah, it's always great having you on and having your insight to talk to the Wall Street Silver community. So, yeah, it's a huge pleasure having you on. The economy is in complete shambles. You're looking at inflation numbers that just came out a couple weeks ago, and not just United States, but Canada and Europe. And inflation numbers are not going down. The cost of living crisis is continuing to increase. Where are you at right now, Jeffrey? What's concerning you in the market? What do you have your eye on?
This has surprised me because I actually 3 months ago was convinced already that inflation was going to fall to a solid 3% and then 2.7 and then 2.5, and then by the end of the year we'd be back down to 2%. I was basing that in part on the wholesale prices and what I was seeing with money supply and that sort of thing. But
Right.
and of course, everything's obvious backwards looking, but the latest inflation data came in. It was, utterly shocking. 3.4 over 12 months. But if you annualize the 1 month increase, it's 7.8%, which, or in energy services, it's double digits. We're looking at 11%. So this is a reversal of a trend. So we saw like a 3 month downtrend. And we all went, oh, this is all going to be okay. And then next thing you know, it's surging back upwards again. And, so it shocked me. I just couldn't believe it.
Yeah.
Reacceleration of inflation. So, looking around for explanations for that was interesting. I noticed that on net, we've seen an increase overall in the money base since April. Actually, so whatever the attempt to suck money out of the economy with these dramatic interest rate increases, didn't actually have an effect, and so you're seeing the overall M2, just on the increase. I mean, it's much lower than it was at its peak, but still, it's we've done nothing to repair the damage of 2020 and 2021. The other thing is that we're seeing, a systematic, as we expected, dramatic increases in velocity of money, which is the pace at which you spend money. So you always have to examine the impact of the money stock on prices relative to its velocity. If people are stuffing the new money in the mattresses, it's not going to have an inflationary effect. But if you're spending and spending and spending, and velocity increases, which has a long way to go out of the depths of lockdowns, you're going to add fuel to the inflationary fire. So what occurs to me, and this has been the question from the beginning, because we have no data to be able to suggest what this would look like. When you're looking at adding over the course of 18 months or something, $6.5 trillion of money supply. What impact is that going to have on prices? At what point does that money become endemic to the economic experience, and then sort of absorbed into prices, and then the inflationary power sort of scuttled? At what point does that happen? And we don't know the answer to that, but I had assumed that was going to happen, already by now, but it's not. So we're still experiencing the effects of the lockdown money printing, and this combined with a failure on the part of many consumers to really understand the economic crisis we're in. I mean, it's pretty interesting. It's great, actually grotesquely irresponsible for the Biden administration to go on about how these are beautiful economic times. We've recovered, the job market's wonderful, and why isn't public perceptions catching up to the pretty beautiful scene we've created?
Right.
As Janet Yellen says every day, this is disgustingly irresponsible. It's like if there were a plague and the CDC was saying, "Don't worry about it, everything's fine. Go out and have fun." And so you're not seeing the shifts in consumer spending like there should be. So instead, what's happening is that people are piling on personal debt while trying to maintain their lifestyles. I mean, they're panicked a little bit, like, Honey, do you think we should go on that vacation? I'm not so sure. But actually, they're just putting everything on the credit card, expecting that everything's going to be fine because they believe the Biden administration, and it's not happening. Well, the other thing I just wanted to mention that is really the idea that the job market's okay is wrong. We talked about this last time.
Mm-hmm.
We're seeing full-time jobs converted to part-time jobs. I mean, that's the upshot of job creation. It's like that. That's not actually great news. But the other thing that I've been noticing a lot of recently is that the Biden administration officials and all this normal establishment pundits are talking about how we're going to avoid recession. Well, okay, but they say, you know, we're not going to see a downturn anytime soon. Well, here's the problem. I'm more and more convinced of something that I've intuitively believed now for a long time, which is that we never actually left recession.
Exactly.
From March 2020. I probably need to lay this out in an article in much more detail. But no matter how you look at it, and that includes job figures, some labor participation, job creation, mostly of part-time jobs, or second and third jobs is another really common thing. But whether you look at industrial production, the trade figures look awful. The GDP numbers are so skewed by government spending that once you eliminate that effect, it falls into the margin of error that we've been basically at zero growth since lockdowns. So if you haven't, so it's weird, right? I mean, they declared what, like a you know, from March to April, like a 1 month recession, and they say, oh, and now look, the boom times are back thanks to the stimulus payments. And now we've been sitting around waiting for the big recession to come. Well, what if it's already here? I mean, that's, you know, what if we never left recession? I mean, that's what's intriguing to me. And also, I'm ever less trustful of mainstream government data on these things.
Yeah.
I was especially intrigued by the Census Bureau's report. I'm sure you saw it. They only do it once a year, where they actually go household to household and say, how much money are you making? And then compare it to inflation. We're on the third year of declines in, nationally speaking, and in the median household income.
Wow.
In real terms, third year. So I don't know what else you want to call recession, but it feels like the recession's already here.
Yeah, you absolutely nailed it, Jeffrey. And I seen an article not too long ago about credit card debt hitting its all-time high recently of $1 trillion just on credit card debt in the USA. So it's like what you were saying earlier, people are just piling on their credit card debt, thinking that it's going to be okay later on. But what do you think is going to happen? What do you think will collapse first, or like the bubble will pop first? Do you think it'll be the banking sector, or will it be the real estate sector, or could it just be the contagion just spread once one big bank goes under, or a big regional bank? What do you think?
Well, I mean, these are all possibilities. My best guess right now is that we're going to see a continual slow grind into you know, a prolonged stagnation. Let me just mention another little piece of evidence in this respect. So usually when you get dramatic increases like this, especially after 15 years of 0% interest rates, you would predict, all else being equal, that you would see a huge rise in savings, because for the first time you can actually defer consumption and make money, even more money than you're losing through inflation, just simply by investing in treasury bills, or these days something like a 1-year CD. You know, that's what you would expect. So you would expect savings rates to increase and a credit card debt to decrease.
Right.
It's because you're being punished for borrowing and rewarded for saving. But what if the resources are not there to make that possible? In that case, you would see exactly what you're seeing now, which is an increase in borrowing from the highest rate sectors like credit cards, and a decrease in saving at a time when it's actually, for the first time in 18 years, they're rewarding you for saving. So what you're seeing, the opposite. And to me, that suggests a massive depletion of capital. And when that happens, you know, there's no digging your way out. You also see it in the dramatic declines in government tax revenue, which I think you just posted about that. So
yeah, that's right. Tax revenue is down like crazy.
Yeah. It
It's
is. So I think the biggest thing we're going to see, and this is sooner rather than later, is a disaster in a series of cities in the commercial real estate
yeah,
and office space market. I think New York is going to tumble into a calamity, and so is Chicago, and so is Boston, so is San
yeah.
Francisco, and Portland and Seattle. Probably Dallas is going to be okay, and Houston. I mean, my friends in Dallas and Miami say life is happy, life is good. Everybody's there's investment, there's everybody's got a job. People are got. It's weird. It's weird actually.
Yeah, it's weird in this different states, and yeah,
Yeah,
it's
you
weird.
know, our economic data is usually assembled on a sort of a national basis,
Right.
but even things like median income. I mean, the reason it was overall declined is because it's dramatically declined in the Northeast and the West,
Hmm.
but in the South, we didn't do a lot of lockdowns and the much lower level of taxation, it's not down. So
Interesting.
so it's strange. We usually think of economic data in a national sense, but I'm wondering, how much that can be true. But anyway, I'm worried about this real estate
Me
problem
too.
in the cities because what happens then, of course, is bailouts. They're going to get bailed
Mm,
out from the capital cities, and which are going to go to Washington, which doesn't say no to anything anymore.
yeah.
So you're going to see, a vast increase of trillions of dollars just to bail out the cities,
And
and bailouts
they'll
will
cut
not work.
rates. Do you think they'll cut rates at that point when they need to flood liquidity in?
Do you know I actually don't think so. And
Really?
yeah, I say this because Uh, I think the inflation over the last 2 years has actually alarmed the Federal Reserve and
Right.
many people at the top level of the systems. I mean, it's actually interesting because we crossed a weird barrier there the other day. From the onset of the creation of the Federal Reserve to today, that's 110 years, have experienced 3,000% inflation.
Jeez.
And yeah, 3,000%.
Oh my goodness.
Yeah, I mean, it's so that is a real marker. And as I was looking through it, I wrote a sort of shortest history of the Fed ever written for the Epoch Times, and what seems to happen here, and it happens over and over again. So the Federal Reserve was founded in part by people who believed that the old banking system that replaced it was too reckless, and
Hmm.
they wanted more flexibility to respond to an increase in demand for money, but they did not want inflation. That was the purpose, was not to create
Interesting.
inflation. There were the sort of
That's
sound money.
interesting.
They had very strict capital reserve requirements for any bank that joined. They were really trying to crack down on irresponsible lending and inflation. Uh, but of course, it didn't work, right? So what happened was, of course, World War One.
Uh,
So the Federal Reserve, must always treat the government as its primary benefactor because the government created it, gives us charters, ultimately manages its board of governors. I mean, the Fed is always deferential to the government
hmm.
policy priorities. So they defer, and then crank up the printing presses. Then the inflation comes along, and they're, oh, this is terrible. Wait, this inflation is terrible. What are we gonna do? And so
Uh,
then they crack down, they raise interest rates, and
well,
then
it's like a
everything settles
cycle.
down for a
Yeah,
while.
it's a
Yeah.
cycle.
And then it starts all over again. So whenever the government is panicked enough, they can always go to the Fed and say, fire up your printing presses. And that's exactly what happened. It's happened
Mm,
over and over and over again throughout every war and every recession. And so, with very few exceptions, I would name just two. 1921, where the Fed just said, screw you, we're not playing your crazy game. Let the
really?
recession happen. And it was gone in no time. It was great. I mean, and that was a downturn that at least in its initial stages was as serious as 1929. So, and the Fed just said, screw you, we're not going to play your
Do you think they'll do that
crazy
again
game.
and say, screw you, we're not going to print anymore. We got to keep on raising it?
I have to say, I seriously doubt it, because the
Yeah.
last time they did that, as you recall, was 1982. And that
Mm,
was a beautiful period, but that was the last time that the Fed actually just let the downturn happen. So I'm not entirely sure how this plays out.
right.
But I do know that so it could just be that political will overweigh the will on the part of the banking community. and they will have to lower rates. But certainly, we've already seen a slowdown in the rate of increase of rates. But if the recession gets bad enough, it also depends on the election timing.
Yeah.
But the Fed's not in any mood to be bullied and intimidated by its political managers at this point. On the other hand, they've always given in the past if it gets panicky
Too
enough.
crazy. Yeah. Well, Jeffrey, this conversation we've had has been incredible. Like, it's such a beautiful experience having you come down to Wall Street Silver, especially talking about everything, how you laid it out, because I think it's going to get crazy in the next year or two. But it's such a huge pleasure having you on. And where can people contact you? Just let them know.
Well, I write every day for Epoch Times, and
Nice.
then I run brownstone.org. So
Right.
that's a good place to go.
Nice. So I'll put your stuff in the description as well, so everyone can contact you or get in touch with you if they need to.
Okay, sounds good. Thanks so much.
Yeah, no problem. Take care.